Hello, everyone, and good morning from myself and David on actually a really cold day here down in Hampshire, but it is December, so I don't quite know why I'm moaning about the cold. Thank you for joining us this morning for the Forex webinar. I know morning, I always forget that we do have people from other parts of the world where it's not necessarily morning, but wherever you are at the moment and you're joining us, you are very, very welcome. Before we start, I know you've seen this all before, but could I just draw your attention to the disclaimer that is on the screen? As you know, this can be a very risky business, and you can, you can lose all of your money, and in some markets you can lose more than you originally started with. So please, please don't ever think of trading with money that you cannot afford to lose. Sorry, I said that so many times I almost forgot to say what I needed to say. Right, there's an awful lot going on at the moment, even despite the fact that we're almost at the end of the trading year. Usually at this time of the year, liquidity kind of dies down, and price action can be a bit spiky. I know we've got volatility anyway because of different factors that are going on. What with here in the UK with Brexit, and we've got the Fed next week. We've actually got the ECB today as well. But I don't really remember a time when it was quite so volatile. Do you, David? I've just asked David for his opinion, and he'll give you his two penneth worth as well. I mean, given that we've been in this game now for, gosh, we say 20 years, but it's actually over 20 years. But on a positive, on the other side, it's never really been a better time to be a trader and try to enter this world. It isn't easy. We don't pretend that it is, and the purpose of these webinars is not only to introduce you to the world of trading, but more particularly through the prism of volume price analysis, which is our main technical analysis methodology. I know there are people in this webinar who've bought the books, and I can see also people who've actually bought our quantum traders, quantum indicators that David and I have developed to support the methodology. But the methodology is just one element of how we believe traders need to approach this whole trading game, if you like. And it is a game, and I mean the game in not in a frivolous way, but in the sense that you have to understand the rules, you have to understand who's making the rules, and you have to learn to play accordingly. And it actually ties in very nicely to an email that I had from someone who bought the books that are up on Amazon, where the VPA methodology is explained. But the VPA methodology sits at the heart of, if you like, a much broader approach. And that broader approach also includes understanding the fundamentals, understanding what is happening in related markets, and increasingly, certainly these last few years, is understanding the political landscape, because you have to bring all these elements together to be able to make sense of not only what you're seeing on the chart, but also to help you make those trading decisions. Now, I can't say that everyone accepts that. I've had some quite strident criticism saying that no, everything is reflected in the price chart. You don't, you can happily ignore what's going on around you. And then when I asked this person, or more than one person, well, actually, it's NFP tomorrow. Do you actually trade during NFP? And they say, oh, no, I don't trade through NFP. Well, that kind of upends that argument. So what I'd like to say is, one of the questions I'm also asked is, given what you have to learn, or what you have to become aware of, and the learning curve that you have to, that you have to start in this, in your journey, how long does it take? And as I said, I had this email, it came in a couple of days ago. It actually came in via Facebook, and it's someone that I've been kind of corresponding with on and off for the last few years, and I hadn't really appreciated what this person had gone off and done. But to cut a very long story short, they had actually started with all the books. They started with the VPA book, then they went on to the Forex for Beginners, then they bought the three-dimensional approach to forex trading. And he was so pleased to tell me that actually it had taken him 5 years of studying, of practicing and putting into practice everything that he had learned in these books, and that he was now a very successful forex trader. He had really got to grips with risk management, and he was writing to let me know that you know, he had developed his own way of coping, dealing, making money from the markets. The foundation was there. The foundation was VPA, the price action, using volume, then the 3D on top to understand the broader landscape. And now he was very, very happy, and I'm absolutely delighted for him. But it took him 5 years. Now, I don't know, that could be simply because he was doing it on a part-time basis, but at least he is there. He started his journey with these books, and now he is successful. And as I said, I'm absolutely thrilled for him, not just for him, but for the many, many hundreds of traders who do write to me and say they have taken elements of what are in these books and have applied them and built on them. Because part of the reason that David and I have been working together with these webinars, with these books, is they're there for you to build on. If you're very new, we hope it puts you on the right path right from the beginning. But if you've you've done a little bit of trading and perhaps it hasn't been as successful as you'd like it to be, at least it may answer some of the issues that you have had with your trading, and perhaps introduce you to concepts and ideas that you may not have been aware of until this point. And as you can see here, I've put it up, and I've put it up deliberately now because what we've done is you can now buy all the books as a box set on Amazon. It's not actually the books, it's the digital version, and I believe it's $9.99, David, isn't it? Or $19.99. So there we are. I'm just going to pass over to David because I know he's got some things to say. But as I said, it's ECB today. It's the Fed next week. So the year is really going to end in a very, very lively way.
Thanks, darling, and a very good morning, good afternoon, good evening. Welcome wherever you are in the world, and it's great to have you along. So a warm welcome. Even if this is your first time, if it is your first time, then we run as a two-hander. We're going to be on MT5 and MT4 today, just for a change. So I've got the MT4, Anna's got MT5. If you do have any questions, just drop them in the chat box. We're happy to answer them there if they're short questions. If they're longer questions, we will answer them on air for you. So we will get going. The only thing I would add to that is really just what Anna said just encapsulates this business. It is hard. It's not something that you can pick up in 5 minutes, but if you put the time and the hard yards into it, it is rewarding. That's all I can say. The marketing hype says, you can do this for an hour a week and all the rest of it. Well, believe that if you will. This is not the case. And basically, that's what we've been saying for as long as we've been doing these sessions and longer. So if you put the effort in, put the study in, prepare to learn, and use some great indicators like we have developed at Quantum, then it all comes together in a very neat package, which of course is all included in the Forex trading program where you get the whole lot. I'm going to pass back to Anna. We'll move on to some charts.
Be able to hear me. I just wanted to bring over the Forex Factory calendar just to remind us. Here it is. This is the ECB. It's really the press conference that everyone is going to be paying very, very close attention to. And the reason it is so important is because it is, I think it's at the announcement or the start of the end of their QE program, David. And it has all sorts of implications given what is happening over in Euroland at the moment. I know the press is that all the headlines at the moment are about a Brexit and the British pound, and won't go bore you with the goings on that have been the carrying on that's been going on in Parliament over this last week or so. It's all been reflected, as you can see, with the pound delivering actually some great trading opportunities. This one is perhaps the press hasn't really been focusing on it, but it's really, really important because in this last year, if you take the two economies, that's the UK and generally the European economy, the UK economy hasn't actually done too badly, despite what's been going on with the Brexit shambles. But over in the EU, things aren't looking quite so rosy. So if the ECB do decide to cut, really bring an end to QE, the commentators are saying is that there's really going to be some serious problems, but very serious problems, real stress again on the euro. I mean, just to give you an example, I mean, we all know about Italy and the budget and what have you, but the Italian banks are having, I mean, they've been shut out of the capital markets, and the ECB won't be buying their sovereign bonds anymore. So it's one of these stories that's kind of taken, and it's not center stage, it's kind of a bit in the background at the moment, because we've had Brexit, and of course we've got the Fed and all the volatility that we've seen in the stock market. It's almost as if the stock market is having a bit of a tantrum, you know, almost saying to the Fed, well, okay, maybe you are going to put interest rates up in December because you said you would, but what about next year? You know, do you realize the kind of chaos and volatility that you may unleash if you carry on the path that you say you've set yourself? And you know, Fed members have kind of been drawing back from that. Oh, well, it's all going to be data dependent. You know, nothing is set in stone. And of course, we have the bond market. The bond market with flattening yield curves, with an inverted yield curve. I think I mentioned it last week. It's at the 3 and the 5. And when you have an inverted yield curve, it basically tells you that interest rates in the future are going to be lower than they are now. Well, that completely upends any rationale for raising interest rates, and that obviously has an effect on the US dollar, etc., etc. Now, all these undercurrents and all these factors that you have to understand and eventually get to grips with, they are all detailed in the 3D book, and they are also covered in very great detail in our Forex program. But as always, if you're very new, we start with the charts, and gradually you have to get to grips with the technical analysis, with the VPA methodology, and then gradually you begin to expand out and you begin to realize that, you know, nothing moves in a vacuum, no market moves in a vacuum. There are these other drivers, these other concepts, elements that you have to bring together, which will actually help to make things help you to make sense of what you see on the chart. And we've had a fantastic example. As soon as the markets, you know, start to feel a little bit more positive, what happens to certain currencies, what happens to certain currency pairs. And I think the one, are you going to be looking at the Aussie yen, David? It's actually got the pound yen at the moment. Well, the pound has also been given a boost from Brexit. And you say, well, you know, why does the pound go up every time? You know, yesterday it went up despite the fact that, you know, Theresa May was going to be facing a confidence vote. It's because the market took the view, or they said that she would actually, you know, win that confidence vote, which she did. I mean, whether you think it's by enough of a margin, whether it's in the long term it's going to be good or bad for her, that's neither here nor there. It's the perception. And what is also quite amusing, David and I find it particularly amusing, and it's the last thing I'm going to say about this, is you will often read, oh, the markets don't like uncertainty. You know, they like to know when things, well, the markets are inherently uncertain. So it's always a bit of a, I think, a bit of a misnomer, David, isn't it, to say, well, we don't like uncertainty. So it's just a question of being perhaps less uncertain than the market environment. Right, that's all I'm going to say about that, the sort of general background. In terms of what we're looking at for from a price, you know, from a pairs perspective, I just want to come back to one of my favorite pairs, which is the New Zealand CAD. And if you've been coming along, you'll know I really have been waiting for this very, very patiently for it to turn, based on the use of our currency heat map. We looked at the heat map last week, and in particular the 3 pairs that I bookmarked, and here they are. in fact, I was in these 3 pairs last week, but I actually closed out at the on Friday because I didn't want to hold the positions over the weekend, and I didn't actually go back in various reasons. And as you can see here, they've actually slightly dropped, and it looks as though they are finally going down. But the New Zealand CAD, this is the one that has been plastered to the top of the heat map, and it's now in spot 2. But looking at the daily chart for the New Zealand Canadian, what I wanted to just highlight again is really the VPA lessons, and I know David's got a couple of things he wants to say about them as well. Is we look at the number of times we've had an attempt to get through 92.39, the amount of volume that's gone into these narrow spread up candles. You can see the kind of pressure to try and move that price beyond there, and it has come to naught. And that is the kind of anomaly that we are looking for on the charts, not only on the longer term charts, but only in the faster time frames. And now what's happened is, because of this constant effort to rise and to go above this price level, we've now got the volume point of control joining the price action. So the key level here for the New Zealand Canadian is in fact 91.19, 91.20. You can see the volume being driven in, certainly on the up candles. We've got a wick to the top of that candle, we have a wick to the top of that candle, and but you know, as I said, all to naught. So we'll have to, as again with this one, I think I'm just going to have to be patient. Is there anything you want to add to that one, David?
Yeah, you can leave it there for a minute.
Yep, perfect.
Just to add my 2 pence worth to that particular chart, and this is a daily chart, but it could be a 1 minute chart, it could be any time frame. It is the beauty of VPA and how you apply it. But the precursor, the initial warning signal to not necessarily a reversal, but certainly some weakness coming into the market, is the first narrow spread candle that's broken above the volume point of control. It's the 3, 6, 7, 8 candles back. Keep going. Left, 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 left. Oh, that one. For those of you who may remember the golden shot, I'm showing my age now, but there we are. It's a horrible program that used to be in the UK. That particular candle there, oh, there we go. We've gone big size now. Brilliant. There we go. That's even better. There we are. That one. That's the one. When you start to see things like that, for example, we've seen rising volume over the preceding days. So the last 6 or 7 days, we've got steadily rising volume, which is good, and we've got rising price. But then we start to see that particular candle where we get a narrow spread on the up day, the next one, darling, sorry, narrow spread on the up day, and we've got higher volume still. That is not a signal that the market is suddenly going to collapse and we're going to go short and off to the races. But what it is a signal of is that this move, which has been extensive, is now starting to become tired. It's running out of impetus, momentum. You've got volume being driven in there on the day, but the price action really hasn't moved very far. It's very, very narrow. So what that's telling you is that the market is resistant to higher prices. There's a deal of selling going on in there. The market makers are still trying to drive the market higher, but the market is resistant to higher prices. So there's selling coming onto the market because, you know, there's been a long rally. Sellers are closing out their positions for all sorts of different reasons, but the market makers are still intent on driving that higher and driving into the weakness. As I say, the point is this: it's not a signal that the market is going to roll over, but it's just simply a signal that there is an anomaly, because volume price analysis is about anomaly or agreement. If something's anomalous, there's a reason for it. You can have high volume with a narrow spread, as we've got here. You can have low volume with a wide spread, all sorts of different things. And they are anomalous, and they reveal signals and clues as to the sentiment and in particular what the market makers are doing at that particular point. But I make the point, it's not about taking that signal. The one thing you have to learn with VPA is that you get all these signals coming in and they're not instantaneous, but what they are telling you is the direction. And when I say the longer term direction, I don't mean the daily or the weekly. I'm talking about on a 1 minute chart. It might be in the next sort of 15, 20, 30 minutes. You have to wait for that to develop, but develop it will. So it's just giving you a heads up on weakness. And we've got, you know, that pattern has continued. We're in congestion. We've got two pivots at the top, the little yellow arrows, which help us to define the fact that we're in congestion. Where is the ceiling of that congestion? Well, it's pretty much there. Below that, we've got a weak floor of potential support, which is not terribly strong, but nevertheless it's there. We're at the volume point of control. We've just got to be patient. We've got two decent levels defined there, and it's a question of waiting for one of those levels to be breached, hopefully the downside. When it is, then it's a question of what point you want to get in. And if that is confirmed with volume, and that's always the key when you're looking at a breakdown in price, then if it's confirmed with volume as a valid move, then really the only decision you've got to make is where do I want to get in? And of course, the other aspect to it is very much this. Considering the heat map as an instrument of reversal, if you will, where you're looking at the extremes, with the currency strength indicator, you're looking at individual currencies in that context, whether at the extremes of overbought and oversold. On the currency heat map, you're looking at it in the context of currency pairs, but the same principle applies. Now, it will depend on your risk appetite as to whether you want to get into this position early. If so, you're prepared to take that position early, and should that ultimately break down, then you will be into the trade earlier than those people who are going to wait for a trend to develop. Once the trend develops, they're jumping on board, but the trend is already underway, so they've lost a chunk at the top of the start of that trend. The payoff is that in taking that position early, you've got to give your stop loss much more room to breathe. So if we were looking at this, for example, as a potential reversal opportunity, the upper ceiling of resistance there, in my opinion, would be too close for a stop loss. You'd have to move it further away than that to allow for any oscillations in price, the buffering that goes on in these congestion regions, the oscillation in price action, could be fundamentally driven, could be all sorts of different reasons, but you'd have to set your stop loss that much wider. If you were trading this as a trend, once the trend's got underway, then your stop loss can be much closer. So it's all about risk. It's about how you want to approach this market, whether you're comfortable taking more risk, whether you're going to be you use reversal tactics as your primary trading weapon, or are you much more of a trend trader, so you like to see a trend underway and jump on an existing trend, and then it's a question of where you want to get in and all the rest of it. Let me pass back to Anna.
And just to finish on this one, and then we have this little candle here, which is it has a wick to the top and a very narrow spread. And again, look at the effort that's gone into there. And in fact, that was this kind of the trigger candle to precipitate the first significant move down. But you know, it really then wasn't ready to move. You know, that was one potential trigger. It did, and then it pulled back again. Again, rising volume there, but that one again, falling volume on that one. Again, it hit that resistance there, and that was, as I said, yesterday's candle. And now it's sitting on the VPOC. We're going into this in this congestion, and really, as David has said, we have the levels clearly defined. How we play these levels is pretty much down to you, and it's what you feel most comfortable in taking as trade. Do you like to, as David said, do you like to sort of get in a bit early and say, yeah, I really, you know, all things are being equal, I really do think that there is potential in this pair to roll over quite significantly. Then I'm happy to get in early because I want to take the you know, as much as I can from this. Or do you want to wait until the move is more clearly defined? But I think David is putting his hand up. He wants to say something.
Yes, we're sort of around the corner from one another, not in different rooms, I hasten to add, but behind screens. So it's I stuck my hand up. Just to pick up on that point is when you're looking at this as an opportunity, and we cover this in detail in the program, but when you're looking at this as an opportunity, it's a question of deciding whether what the opportunity has to offer, you are prepared to offset that against the risks that you're prepared to lay on the table. And this is actually a classic example, because when you look at it just from a very simple perspective of looking at the price and where this could potentially go, and more importantly, where it may run into some difficulty in developing the trend, And you only have to eyeball it, and you can see down at the sort of 0.9060, 9016 area. So where are we trading at the moment? 91.67 down to 90.16. So we're talking maybe 100, 150 pips, something like that on, and bear in mind, this is obviously a longer term position that we would be considering. So whilst that sounds a lot for a daily move, you know, you could be in this for several days, for example. So the question is, in looking at that chart, the offer on the table would be something like 100 to 150 pips before we would expect the market to run into some pause point, some congestion, for two reasons. Firstly, we've got price congestion to the left in that region. And secondly, we've also got volume building just immediately below it. So at the very least, on the volume point of control on the histogram. So at the very least, we would not expect this market to develop a price waterfall unless there was some core fundamental reason for that. From a purely VPA perspective, from a technical perspective, that's the sort of question that you have to answer yourself before you take any position in the market by studying the chart, and obviously you'll be looking at this in different time frames, and just asking yourself the question, okay, I'm going to put, let's say, a risk of 100 pips on the table. Is this going to deliver enough for me? Is 100 or 150 enough, or am I looking for more? Now, once you get below the next level, at 89.28 area and down into the 88s and 87s, that is much clearer in terms of what is available on offer. So if you were looking at that as a potential reversal, for example, or a potential opportunity, the possibility of the market pausing from a technical perspective, either from price-based congestion or volume-based congestion, is much cleaner. So you've got, in that case, you've got something like, I don't know, 300-400 pips of potential opportunity, assuming the market does continue that far. So it's always a question of looking at the charts and trying to understand what the market may deliver, not through one of these absurd risk-reward relationships, but through the prism of the chart itself. And from a technical perspective, what you can see on the chart and what is likely to cause that market to hinder progress of the position that you're taking. So I just wanted to make the point because it is a nice example.
Okay, and really just to finish off on this one, we weren't going to look at the VPOC in detail today. That's the volume point of control, where we have volume, price, and time, the three elements to help define these additional support and resistance regions, but also through the, but not only the levels per se, but it also gives us an indication of how slowly, or the effort that is going to be needed by this pair to actually move through these levels. So for example, when you have this histogram moving, where you have a very deep, a very wide point on the histogram here, and you have very sort of deep, this is, it's called a high volume node here. What that also tells you is that yes, you may get this reversal and we may see it roll over, but it is going to be, it's going to take time, and it's not going to be, it's not necessary, and it won't move through with any degree of great momentum. Where you get momentum on a chart, and how that's picked up by the volume point of control, is where you have an area like this, where you have what's called a low volume node, and that's always great to see, particularly on the faster time frames where you don't want to be in for very long, and you know you're in a position, and the pair comes up to what we call a low volume node. That's always a real comfort, because the chances are it's going to go through fairly quickly. By contrast, if it comes across a region where a high volume node is where prices sort of congested in the past, as it were, and there's been a degree of price agreement in the past, and it's built up these they're like hedges, if you like, thick hedges. You know, especially if you're on a faster time frame, that you think, yeah, it probably is going to go through, but it's going to take time and effort as well. So that's what I've got to say. Do you want to say anything about the VPOC on that, or is that's it? Right, before we move over to David, he's been looking at the CSI just to see what's been going on. I just want to have a look at the dollar, and in particular the dollar index, because it's actually on the daily chart, it's actually quite well, it's very, very interesting. I've got the Camarilla indicator on here as well, just to give me some key levels. But the most important thing that I noticed about this about the dollar index is so far the inability to actually get past the 97, is it 97.50 region, yeah, somewhere like that. And we've actually had three major attempts at it. We've had here, we had a 2-bar reversal, then we had a 2-bar reversal here, then we had another 2-bar reversal here. And when the dollar, you know, on any chart, when you see the sort of almost like a triple top here, it's always a very significant chart pattern. So with the dollar, we'll see if it's actually setting up with you know, what may or may not happen next week with the Fed. And it's certainly going to be all dollar news from now on. But the daily chart for the dollar index is possibly hinting at what may come in the next week or so, and certainly running into the end of the year. But more importantly, this year is going to be finishing, obviously, but what is going to be happening next year? So that's what I want to say about the dollar. How to move over to you, David? Is that okay? Yeah, yeah. Have you got? Are you going to talk about the VIX? You're going to talk. What's that?
All right, just seeing what David's bottom month counts. Yeah.
Are you going to? Would you? You got the VIX up?
Yeah.
Okay.
Yeah.
But one of the we always have to, as traders, we always have to try and look for clues as to what market sentiment is and what is happening, you know, which currency or currency pairs are likely to move. And one of the related markets we look at and look at closely are the volatility indices, and in particular the VIX. And you think, well, you know, the VIX is used for trading indices and trading stocks, and you think, well, why, you know, what has that got to do with forex trading? But it's one of those really important indices that we need to be aware of, because if the VIX is elevated, then we know that the market is very volatile, and you know, that's going to be reflected in certain currencies and in certain currency pairs. So it's just another way of getting a heads up of what is going on in the broader market, which will then be reflected in price moves on individual currency and currency pairs. And whether you're looking to trade speculatively, in the sense that you don't, you know, you'll trade anything that happens to be moving or is likely to move, or it's, you know, you're focused on a limited number of pairs, you should still pay attention to it, particularly if you have a yen in your currency pair of choice. I'll move over to you. Is that okay?
Just switching screens. I thought I'd go to, does that come up okay? Yep, fine. I thought I'd run on MT4, so this is one of our live accounts on MT4. And just to pick up on, to focus on the yen really, let's just go to the CSI. This is the CSI on 15-minute. And this is the Japanese yen, which, as you can see, has been selling off quite strongly, and as a direct reflector of risk sentiment. And the counterbalance to that, we've seen the British pound rising quite strongly, and the euro was rising. That's now kicked over, but certainly as far as the pound's concerned, that's still continuing to rise. But what's interesting, this is on 15-minute. What we're now starting to see, and again, it comes back to what I was saying earlier about whether you are more comfortable as a reversal trader or whether you're looking for opportunities to jump on a trend. So, for example, if you were looking at trends, you might be looking at something like the Aussie, which has already rolled over, the blue line, that's falling quite strongly, or the New Zealand dollar, for example. This is the Canadian dollar. It was very strongly oversold. It's now starting to rally and may well be developing a trend on one of these pairs. So it's a question of what you're comfortable with. And the other aspect, of course, also is how these reversals, these overbought and oversold regions then play out in terms of the chart itself, but also in the faster and slower timeframes. This is on 15-minute, where we're still seeing buying in the pound, and we've got this very strong selling in the yen, which is now starting to bottom out. But if I drop down to a 5-minute chart, what are we actually seeing? Well, that buying of the pound is now starting to find some weakness on 5. It's starting to roll away from the overbought region. It doesn't automatically mean that this is going to continue all the way down for us very nicely to the bottom, and the yen, for example, is going to come all the way up to the top and deliver us a nice trade. It may well do, but what it is signaling is that there is a pause point coming in terms of the pound. And if we hop over to the pound yen chart, which is down here, I've got this on 5-minute. And again, it's a question of using multiple time frames. What are we seeing on the 5-minute time frame? Well, it's understandable as to why we're seeing this pause point, because we've got the volatility indicator was triggered several bars ago. For those of you familiar with the indicator, you'll know that it's first of all, it's signaling volatility. In other words, the price action has moved outside the average true range for that particular pair at that particular time of day. It's like an average, if you will. So whenever that happens, you can be assured of two things. First of all, you're going to see some wide price action. Secondly, it is the entrance of the market makers who invariably use volatility as a mechanism to frighten traders into weak positions, particularly when it's associated with high volume as here. Clearly they are participating. This is a trap move. And what it's designed to do is it's designed to trigger the emotion of the fear of missing out. When you see a move like this, the market is moving very, very fast indeed. And your instinct, your natural emotion is to jump in. Oh, I don't want to miss out this trade. I've got to get in. It's moving fast. Fantastic. The corollary to that is that once that's occurred, the market makers will then move the price action into sideways congestion. Why? Because you will now start to suffer the opposite emotion. That was the fear of missing out. Now the emotion is kicking in that perhaps you've done the wrong thing. As time passes by, that fear becomes ever stronger. That emotion becomes stronger. You're not sure. Uncertainty starts to build. And ultimately, you may close out because you can't take the pressure anymore. You might get stopped out, of course. And ultimately, if this is a full-blown reversal, you will get stopped out. But the key is that it's congestion which triggers that emotion, because time is now passing. You jumped in here and you're starting to regret it. Now, the question is, if you're in an existing position at this point, and this happens a lot, two things. First of all, you've got a decision to make. But secondly, more importantly, when this is occurring, what actually happens is the indicator is triggered in real time. So whenever that condition is met, this will be triggered. You don't have to wait for the end of the candle to form. It's not a trigger that is delivered, or an indicator that delivers once the price action has closed on the candle. It will arrive as soon as that condition of moving outside the average true range has been met. So you will see it instantly. And I have to confess that if I'm in a position and Anna's in a position and we see that trigger, our natural instinct is to close out. Now, of course, alternatively, it may be going against you. Again, you've got to make that decision. Do I close out? What do I do? But if we're in a strong position and we see it, generally speaking, I'll say 9 times out of 10, we will probably close out, sit on the sidelines, wait for the congestion to follow, and then ultimately decide whether we want to get back in or not. As you can see at the moment, in terms of the trend monitor is still blue. So we haven't actually transitioned to any other color yet. We're just in a pause point. We're just in congestion. You can see up here we've got a pretty strong region of price resistance, which is building on this solid line on the support and resistance indicator. So there's lots of reasons to consider this as, first of all, a congestion phase. Secondly, as a potential reversal opportunity. And if we go up to the 15, and this again really highlights the importance of using multiple time frames, is that what we're seeing on 15 is really just replicating what we've got on 5. In other words, we've got another volatility trigger. So we've got volatility on 5, volatility on 15. There's 26 reasons why this market is going to go into a pause and potentially a reversal for the time being. And that really is what we're seeing in terms of the CSI. We're starting to see that roll over now on 5, on 15. It's coming to a pause point. But again, if you go down to 30, You know, there's still a little way to go. If you go up to an hour, we're still rising. The yen is still falling. It's all a question of what is your focus of your time frame. What are you looking at in terms of your window of opportunity? Are you looking at a window of opportunity of 5, 15, 30? Are you looking at this over an hour, 4-hour daily? Whatever it is, you will have a different perspective, and the multiple time frames will give you a different perspective in terms of your field of vision. And it is very much that. It's the analogy I've used many times before is of a racehorse. Some racehorses are blinkered because they have to be focused on the finishing line, and it's kind of like that with trading. It's trying to block out a lot of the peripheral vision and really focus in on your chosen time horizon for that particular trading opportunity. Now you can, it doesn't necessarily mean you always have to be a scalper, or you always have to be a trend trader, or you always have to be a swing trader, whatever it may be, or you're always trading slower time frames or whatever. You can do all of these things at different times. It's just simply a question of deciding before you get in what it is you're going to do, because it's so easy. We all do it. We get into a faster scalping opportunity. It doesn't quite go our way, so we look at the slower time frame. Oh, well, okay, well, actually, I'll be all right. You know, if I hold this for a longer period, I'll be all right. We all do it. It's very easy to do. You have to try and impose that discipline to focus on really what it is that you're trying to do on that particular trading opportunity. Just seeing that develop. Just hopped over onto, this is the currency array. And the nice thing with the array, when you have it on yen pairs in particular, is because the yen is always the counter currency, it gives you an instant heads up as to the universal aspect of yen flows. In other words, are we seeing yen buying and yen selling across the complex? And in addition to that, we can also identify very quickly which pairs are delivering that most strongly, which are weak, and whether the sentiment is now getting to a point of, we've got the ranking ladder here where we've got potentially overbought and potentially oversold regions appearing in terms of the currency pairs themselves. But we're also starting to see whether that strength is weakening. And if so, then you will start to see all these pairs move in lockstep together. So the yen complex is a really nice one to visit all the time for yen sentiment. Somewhere down here, forgive me, I've got the, I think it's on this one. There we go. We're on the euro yen here, but what the reason I've got this is because this is the yen index, and it's clearly showing you what is going on in terms of yen sentiment right now. And hopping over to the, there we go, this is the VIX, which I've got up here on the daily, but we could put that onto any time frame. And this, if you're not familiar with investing.com, it is a brilliant site. It's truly brilliant because you will find all the things which are really hard to find here. You'll find all the bonds, bond yields, bond prices, which tell you so much about sentiment, you know, what is going on in the market. You'll get the Globex prices here. This is the S&P 500. This is the future. This is trading at the moment. You can see we're ticking up a little bit. You know, there's some bullish sentiment there. That's why you're seeing the yen selling off for the time being. That all may change as we get towards the US session, but that's what's going on. These are the cash markets here, but you will find it all here. And this is the VIX, which is currently trading at 21. If I go back to the daily, what's interesting about the VIX is that, again, in a similar way to what Anna was saying about the triple top, we've got a similar situation here with the VIX. And remember that this is inverse. So when the VIX is rising, then it's risk off. When the VIX is falling, it's risk on. We've got a similar situation here. We've been trading in this range for some time now, with all the volatility in the US markets largely driven through trade wars, embargoes, and all the rest of it, which is getting, I have to say, a little bit tedious, but it just goes on and on and on. That's why we're seeing all this volatility. Once this starts to calm and the risk sentiment returns to a longer term perspective of risk on, then ultimately you'd expect to see the VIX move below this level and back down into this region over here of 10s and 12s, where it was trading for an awful long time. And really this just reflects the volatility that's been experienced in the market over the last few weeks. Let's just drop that out of the way again. Let's go back to our pound yen. Let's go back to the 5. Let's see what's going. Yep. Yeah, sure. I'm just going to transfer over to Anna on the pound yen. And one of the ironies at the moment, I have to say, has just come to my mind, is that normally the pound yen would be the most volatile of all the pound pairs. I can tell you right now that whatever pound pair you're trading, they'll all be volatile. What did I say? Sorry, yeah, I meant the pound pairs. Whatever pound pair you're trading, whether it's a pound yen or a pound anything, it will be volatile. Normally the pound yen would be the most volatile of all, bar none. But now I can assure you, over the next few weeks, months, whatever it may be, you'll see volatility across every single pound pair. So whether you're trading cable, whether you're trading pound Swiss, pound CAD, doesn't matter. You'll see volatility.
Okay. Just a couple of things I wanted to say about the pound yen. David's got a slightly different set of charts set up than I have on his MT4. One of the advantages of MT5 is that you have a lot more time frames that you can play around with. But this is I wanted to bring up the 3-minute chart because it's a really nice example of lots of things actually. This is the move higher that's started back in it's about 7:20, yeah, just before the London Open. Then of course we had the London Open, we had the usual volatility, but actually this is the move high. We've got the trend monitor blue, then we had this volatility candle which precipitated the retreat to within the spread of the candle. We have a very clear resistance up here at 143.88, but we also have in a microcosm of what we were looking on the New Zealand CAD pair, and that is, this is a 3-minute chart, but we have the same chart structure, we have the same candles and price volume relationship. So you have a move higher. And this occasion we had volatility, a lot of volume going on under that volatility candle. Then you had the wick to the top of the candle. So we know that weakness is going to come in. It was also highlighted on the other indicators such as the CSI, but things don't roll over immediately. We went into a period of congestion, and in that congestion you can see some fairly widespread candles. Not a lot of volume. They're beneath the sort of average volume line here that we've developed with the tick volume indicator. And we know here what we're really waiting for is a rollover, but it doesn't happen immediately, even on a 3-minute chart. But what's interesting is look at where the price action is now. When I said earlier that we have a low volume node here, a low volume node is because in the past the price went through very, very quickly. It went through quickly because there was momentum behind it, because of the and it triggered the volatility candle. Now it's sort of hovering there. All we can say is that if it does actually continue lower, it's going to go through this reasonably quickly. It's not going to take the time that it's taken to come through this volume node here, which is high-ish, because you can see from the histogram. So if that's going to go, it's going to go fairly quickly. Where's it going to go? Well, there's a support line down here at 143.57. So this is what volume, well, certainly the VPOC, where you have volume, price, and time as part of the mix, also helps you to determine. So, you know, if you were short here, I'm still waiting for that to break through. If it's going to break through, it is going to go through fairly quickly. Then it's going to hit a reasonably high-ish volume node. So what does that tell you? Well, if it gets through there, then it's going to take a little bit more time. And then if it's going to carry on, then we have another low volume node. And this is what volume also tells you. It's not just a two-dimensional thing with price. It also gives you, because you've got the time element in there as well, it also takes away it takes away the uncomfortable feeling that it's very easy to become prone to when you are sitting in a trade. Now, what I was going to say as well is we also have developed a non-time-based chart to use with time-based charts, and this is the Renko. The Renko is picking up the price action. This was the move higher. This was the little pullbacks that we see here, and this is reflecting now this move lower. And what will happen with the Renko, because the price is also reaching a low volume node on the time chart, if this is going to go, it's going to go fast. And we know there's volatility and momentum coming in is when the Renko bricks start to develop these wicks. If it's down to the downside, you want to see it developing on the downside, and obviously upside to the upside. So it's really, really interesting to look at price action, as I said, not just through the prism of price, but also through the prism of volume, and also time as well. So it's just another way of looking at what is going on in the price action. And of course, this is all actually against what we see in the daily chart, because we can see here we've had this bullish engulfing candle here yesterday. We've got lots of volume underneath it. Then it carried on higher because risk sentiment. Why risk sentiment? Well, you know, the market was selling the yen. When the yen is being sold, markets are feeling a little bit more comfortable, a little bit more positive. And what we're looking at is this tiny bit of a wick to the top of this daily candle. But, you know, given the range that the pound yen moves, that may be, it may be a trade worth taking. But just have to look at where the prices stop, the support lines that come in. Hasn't managed to get through there. It's just a case of, you know, waiting and seeing what happens. Anything else you want to say to that, David? Or
no, just a couple of things.
Yeah, sure. Leave the 3-minute chart up. Yeah.
Just to pick up on what Anna was saying, it is one of the. There are many abuses of the MT5 platform, and also I would say if you've started with MT4 or you're thinking of MT4, MT4 is a great place to start because the two platforms are very similar in look and feel, but what you get with MT5 over and above MT4 is first a much broader array of time horizons, and secondly, of course, you get access to different markets. So in a way, it also gives you an instant view, for example, in terms of what is going on in US indices, because you'll find them on MT5. So it negates the need to go to investing.com, for example. So you'll have them there, you'll have commodities, you have all sorts of things. So it's just a really strong platform. The one thing I just wanted to add to that was when you look at the trend monitor here as well, again, it's kind of looking at it from, well, where do I want to get in? The trend monitor's already started to transition. The trend dots always move first. The trend monitor will move second. And the reason is very simple. The trend dots are very close to the price action. You can see on the chart there that we've gone through the blue phase. We had a single grey dot of transition. The trend dots have flattened. We had a single grey dot transitioning there. And then we've gone into the red dots of bearish price action. But in terms of where that actually happened, it happened quite a little bit before the trend monitor itself decided to transition. So the trend dots transitioned there into full-blown red, but the trend monitor is still in one of the transitional colors. It's gone from bright blue, it's gone to darker red. If this is a full-blown transition to bearish sentiment, then ultimately that will go bright red. But for the time being, it's still dark red, but it's just signaling the fact that the trend has run out of energy. It's in a congestion phase. The trend dots are signaling a transition. The trend monitor is following along because the trend monitor takes the more considered view of price action. It takes a broader view, whereas the trend dots are very close to the price action and give you an instant heads up. The trend monitor will take a more considered view. So it's always a case of moving them, of using them in combination, in tandem, not in isolation, because they move at different speeds. The trend dots move first, give you the heads up. The trend monitor then really pulls it all together in a more considered way. And the great thing about the trend monitor is once you're in a position, it's trying to help to keep you in that move because the trend dots will change, but the trend monitor, through that prism of a slightly slower time perspective, will help to keep you in through those inevitable pullbacks and reversals that you get in every single move that ever occurs in the financial markets. Just going to pass back to Anna.
One final thing about the MT5 platform, which is a feature that I've mentioned a couple of times already, and that is the ability now that we have to take the charts out of their profile and move them onto another screen. So all you do is you right click on the chart and you have this symbol here called docked, and you take it, and what happens is away it goes. I've actually moved it over to my screen on the right hand side, and it just makes life a little bit easier when you're, particularly if you're monitoring obviously lots of different time frames, or you've got another chart that you know, an indicator on a chart, whatever indicator that is. In fact, I've got one. Where is it gone? Have a look. Yeah, for example, here I've got the I've got my heat map with the yen. Let's move that over with the yen pairs, and it's quite interesting to see which of the yen pairs has actually has moved most strongly. And in fact, the New Zealand yen is at the top, and the pound yen is it's not quite a laggard, but it's just one above the Canadian yen. And all you do again is simply just hit the docked, and you can. In fact, I had it docked already. Let's have a look. Let's see. Hopefully, I can move it. Yeah, and away it goes. So it's just a really nice, neat feature that is on the MT5 platform. Anything else you want to say to that?
Just a question about the MT4, MT5 heat map, whether it works on both. I have answered it, but you just want to answer it.
Yes, the heat map is available for both MT4 and MT5. The only feature you don't get on MT4 is I believe you don't get this a docking feature, which is really, really useful. So anyway, we'll leave it there. We'll see what happens with the pound yen, which actually was a bit sluggish actually for the pound yen. It's I don't think the algos are in there at the moment, but we'll see what happens with as I said on the 3 minute. It's really just waiting to see if that low volume node is going to give the move to the downside a little bit of oomph to it. It's interesting that the Renko it keeps sort of dipping out this slither of bright red, and this is what you really want to see. You know, taking a position on a transition color is much more high risk, if you like, than waiting to see that when the color is either bright blue or bright red. Right, that's all I've got to say. We've actually run on slightly longer than we anticipated. If I could just highlight a couple of things for you. I've just moved first of all, the indicators. If you've not come across them before, you'll find them at quantumtrading.com. There are lots of videos, lots of support pages. You can buy one, you can buy the package. If you buy one, there are bundled whatever you buy, whether it's one or a bundle, and then you want to upgrade, you will always be credited. If you buy the complete package, when we develop new indicators, they are automatically added to your package for free. So you only, whatever you pay, that's it. I mean, we've got users who joined us when we only had, what, 10 indicators, David? Like 8, yeah. And how many have we got now in the package? 17. We've got 17, so they've benefited to the tune of 7 extra indicators, and all upgrades are free as well. We've mentioned the Forex program. This is details of the Forex program. The Forex program includes the program, but also all the indicators as well, and you will find details of the program at Quantum Trading Education. And all I was going to say, it includes 5 core modules, including advanced VPA, 50 hours of videos, 13 PDFs, and really you can learn at your own pace. So, you know, whatever time you have available, the material is always there for you. And the cost of the program, that includes the indicators, it's $13.91 for MT45 and $16.94 for NinjaTrader. That's because we've got more indicators on the NinjaTrader platform. We are also developing other platforms. TradingView is actually up and running. Not quite as many indicators on TradingView. You can find us at the TradingView platform, although there is one indicator on there, which we don't have at the moment for these other platforms, but there will be. And that is, we have a pound index. We've done it for TradingView, works really, really well. And we'll be getting the developers to add it to the MT45 and NinjaTrader platforms as well. And you see we have a euro index, a yen index, a pound index, and now a euro, a yen, and a dollar, and then there will be a pound. And if you have the package, again, it's automatically added to your package because, as I said, you just pay us once. And the other thing we have as well is that if you're not happy with anything that you buy from us, you do have a 7-day money back guarantee. That's what I said, support, that's it. And more information on the education, quantumtradingeducation.com, but you can email me, Anna at annacoolan.com, or you can email David at quantumtrading.com. Brilliant. Are we back next week, David?
We are.
Oh, we are. Right. The week, yes. Yes, I suppose so. It's Thursday, isn't it? It's the Wednesday's the Fed. In fact, yes, I think we're going. I'm not sure of the time because obviously it's the week before Christmas, but we will be adding a couple of sessions in, and then we are back to a full program in January. We're actually going to be putting more webinars on. We're going to be doing a webinar-specific index room. Yes. Just for indices, just the indices and day trading, and commodities. Stocks is going to be separate as well. So all sorts of good things happening in the new year. But we are back next week. Just keep an eye out on your email for the times and dates. As I said, what with Christmas and coming up, and things that we've got to do. It's got to be a little bit flexible, but very important that we do one. Certainly, considering what the what happens with the Fed next week. And please do keep an eye on what is happening with the ECB today. So lots going on. Enjoy the rest of the trading day. I hope you've enjoyed what we've done today. You've learned something possibly that you didn't know before, and we will see you next time.